The effects of climate change will be felt globally, but the impact on Southeast Asia could be bigger than most regions, according to the Asian Development Bank. It expects climate change to shave 11% off the region's GDP by the end of the century. While climate change poses a significant threat to the region, it also presents significant opportunities for green financing to flourish.
There's going to be significant demand for new investments to decarbonize the economy going forward. Now, and Singapore, being a key financial center, is well positioned to plug some of this massive financing gap in more sustainable ways. The Singapore banks have recognized this early, and they're coming out of the gates running.
Strong regulatory support and government-led incentives have helped the growth of green finance in Singapore. One example is the $2 billion Green Investments Program launched by the Monetary Authority of Singapore last November. The scheme will invest in public market strategies that have a strong green focus.
MAS has grants to defray the cost of green certification for borrowers to access both green loans and green bonds. There are also a lot of soft aspects which are equally important, such as organizing industry working groups to build pools of expertise and to harmonize some of the regulations and standards to drive consistency.
These initiatives have produced tangible results. All three Singapore banks made it to the top of Bloomberg Asia's most recent Green Loans League table.
Banks in Singapore have come out and made public commitments towards not only managing the carbon emissions and sustainability programs of their own operations, but also making commitments towards green financing. So it's a question of banks now really holistically looking at climate risk and environmental change aspects, and then incorporating the risk management aspects, but more importantly also to realize the opportunities that exist in funding the green economy.
Still, analysts say the amount of sustainability-linked loans issued by the banks pales in comparison to their overall loan book.
Say a bank issues a record $10 billion of new green loans in 1 year, that will be huge. But relative to the existing portfolio of, say, $300 billion or so, it is not going to immediately move the needle. So it is going to take time to turn the portfolio green. And until then, you're just going to have to deal with skeptics who say this is just lip service or this is just a public relations stunt. You know, it's actually an incremental step in a relatively long race.
OCBC aims to grow its sustainable portfolio to $25 billion by 2025, while DBS is committed to financing $20 billion in renewable, clean energy and green projects by 2024.
So the banks are certainly making strides in product innovation and diversification. Instead of slapping a couple of green conditions to refinance an existing loan, for example, and calling it green, we have seen banks launching new products into the region last year. So now we have a green sukuk. We have more sustainability-linked loans where an interest rate can potentially be lowered if you hit certain green goals. And banks are slowly increasing their lending to the non-property sector, such as renewable energy or waste and water management.
For many of the banks, they have sector approaches. Now, in each of these sectors, the banks can take a different approach to financing the needs. Increasingly, some of these structures are consortium-based and therefore needing regular monitoring and reporting back.
As governments in the region rebuild their economies amid the COVID-19 crisis, there has been an increasing focus on building greener economies. And Singapore banks are well positioned to ride this wave of opportunity.
Banks will then have to be starting with their own frameworks to be able to identify what are the environmental and social outcomes that they are supporting, be able to then measure them and then make an assessment as to where they will be directing their efforts.
With dark green finance often refers to green buildings, renewable energy projects. And what we would like to do is to really scale up sustainable finance. And that means we have to finance not just the dark green, but we need to move into areas that may not be as green as we would ideally want it to be. especially heavy industries, such as cement production, steel production, a lot of the mining and metal smelting, they require the use of fossil fuels. And it is actually really difficult now to find commercially viable, affordable solutions that are greener. There are some, but it may take some time for them to become truly scalable. And in the meantime, we believe we should still encourage customers to adopt better solutions.
Choosing a greener path could also reap rewards for the banks in the long run.
From a long-term basis, very clearly, these sustainable finance instruments are going to be helping banks not only in terms of their profitability, but their consumer perception and the overall brand that the bank stands for.
A bank that has a robust or strong ESG mandate and policies is headed in the right direction, and therefore keep in tandem with the market opportunities that the banks are seeing, and therefore the growth potential in itself would be fundamentally, safeguarded. But what we are not yet seeing in the market is a very direct causal relationship between ESG investments vis-a-vis the share price. There have been many studies that are done that shows a positive correlation between the two, but I think the causal relationship has not yet been established.